All right. Good morning, everyone. Today we are going to do a revisionary session on foreign exchange management and risk management pertaining to the foreign exchange risk. We had learned originally in the sessions which we had done earlier in the month of December why we need foreign currency transactions. So I'll just brief up on that, build some concepts thereafter, introduce the concepts so that we are aware of that, and thereafter we will also go through some of the practical questions so that our concept becomes that much more clearer, right? Now, first and foremost, why do we need foreign currency? In today's time, majority of the transactions are happening in international currencies pertaining to between various countries, right? Within the country, we have our local national currency, domestic currency. However, when you want to do any transactions internationally, you would need foreign currency. Now, what are those kind of transactions which may be there? What are the different types of transactions? Any trade which you are doing, for example, with any international country, obviously when you do a trade, you need to make payments for the same, right? You may have maybe investments, either investments coming into India, right, which may be called as FDI or FPI, etc. Or it may be the other way around where investors from India are making those investments. There could be because of tourism. As you know, tourism has been flourishing. A lot of the Indians are now exploring tourism options across the globe. There could be various other reasons where you may require, for example, you may have borrowings, etc. Right? So in all these transactions which are happening outside your country, you need foreign currency for the same. Now, whenever we need foreign currency, so we obviously have to then talk about what is the forex rates in that case, right? Or what is forex? So forex is nothing but foreign exchange. So as you know, we have learned earlier as well that foreign exchange basically is nothing but where you are exchanging one currency for another currency. So to say it simply, let's say, for example, today, if I'm buying one pen, right, which is costing rupees 10. So what is the exchange for me as far as this pen is concerned? One pen is costing rupees 10 for me. Rupees being my domestic currency, I am in India. So my domestic currency is rupees. So any transactions which I am doing in India, I am generally expressing those transactions in terms of rupees, right, as a medium of exchange. So I have one pen, which is, say, for example, rupees 10. Maybe I am saying one apple, which is, let's say, rupees 20, so on and so forth. And similarly, if I have to buy today one USD, I am saying I want to buy it in, let's say, for example, it is going to cost me rupees 90. So just like any other commodity, I am buying now a foreign currency by paying for the same in Indian currency. Now, the moment we talk about two currencies exchanged in front of each other, then the question arises, how are we expressing the currency codes? So there may be a direct or indirect method of expressing this currency codes, right? So you can see over here, when I'm buying for one pen rupees 10, one apple rupees 20, because that is my local currency, right? So when you're expressing one USD equal to rupees 90, in other words, what I am saying is it is rupees 90 per US dollar. Am I right? And this essentially means it is a direct code. Why do we say direct code? Because I can essentially say I am buying one US dollar for rupees 90 in my local currency, in my domestic currency, right? The same thing if expressed indirectly, meaning if you are told instead of this, that for every rupee, you can get X amount of dollar. So I don't know the precise cost because you know for a fact, if I am essentially trying to buy currency, it will be in multiple of, or at least units of 1 and so on, right? It is not going to be indivisible. I'm not going to buy in today's time 5 cents or 10 cents. So it is an indirect quote. Just like, for example, if somebody were to tell you, instead of 1 pen is rupees 10, if they say that I will give you 10% of this pen for rupees 1, you know for a fact pen is indivisible. I would need to buy the entire pen. So now you need to convert this into an entire cost of pen. So you have to do the work of converting that. That is indirect quote, right? So generally, how do you express that quote? Direct quote is always where you are expressing this currency, which is called base currency, right? This is a direct quote. So the one which is in the denominator is known as base currency, and the one which is in the numerator is called your pricing currency, right? It can also be called as the reference currency. Similarly, your denominator can be called as base currency. It can also be known as a quoted currency, right? So now I have direct quote and indirect quote. Direct quote is this, indirect quote this. Indirect quote, generally I like to express it as rupees 90 upon dollar. So I'm essentially mentioning my home currency, how much home currency I will have to pay to buy a foreign currency, right? Indirectly, I'm basically classifying that particular currency, foreign currency, like any other commodity which I go in the market, how much I will pay in my local currency, right? So that is a direct quote, and indirect quote is the reverse of the same, right? Inverse of the same. All right. Now, quotes are also given in terms of something known as American term, and you have European term. What is the difference between American term and European term? In case of American term, they generally would express it as dollar, US dollar in the numerator, and denominator will be any other foreign currency. On the other hand, European term is essentially going to put US dollar in the denominator, and it is going to take any other foreign currency in the numerator. Now, between these two, if you look at it, how we express, that is internationally, either you are expressing in terms of American term or European term. You will find in India, the quotes that we generally follow is, say, for example, this particular direct quote, right? This is how we generally quote the currency exchanges. So, in other words, we are expressing in European term or American term. Yes, US dollar over here, you can see, is in the denominator. That is what we follow. So, we are also following the European term of expression, right? Now, one of the important aspect, again, say for example, if I have to invest in a US stock market, how much will be the returns which I will earn? So you have a particular, when we were solving this particular example, or rather this particular concept, in the sessions which we had recorded in December, I had explained you in detail as well, right? However, we had also discussed the easy format or the formula which is available to us for the examination purposes, because in examination, not only you need the right answer, but also timing efficiency is important, right? So how do you go about computing that particular return? So say, for example, to say it very simply, let's say I have Tesla is, say, for example, costing in the spot right now is costing, let's say, $50. Okay. Tesla share is currently costing, let's say, for example, $50. And a year later, it is going to cost $60. Dividend declared during the period per share is, say, for example, $2.50. Right? So Tesla is costing currently 50. A year down the line, it is expected to be having a price of $60. So I have used over here S0. Instead, we can also use the term P0, P1, right? Because that is what you are generally accustomed to when we are calculating HPR, right? Holding period returns as well. So now on this particular share, what is the return I am earning? How much is my return? It will be P1 minus P0. Am I right? That is the capital gain plus revenue income, right? Which is dividend per share. So that is DPS upon original price, which is P0. So I'll get over here 60 minus 50 plus 2.50 upon 50, right? So how much is that coming to? 12.50 upon 50. In other words, this will come to, if I say into 100, it will become 25%. Now, this is the 25% return which is being earned by this security, which is quoted in dollar terms. Now comes the element, because I don't have the direct access to that, right? I will have to essentially convert my INR into dollars and thereafter invest over there. So how does my process work over here? Say, for example, my Forex rates are, say, for example, 1 USD is equal to, let's say we say it is rupees 81.50. Okay. This is at the beginning of the year, right? At the beginning of the year. And 1 USD by the end of the year is costing, say, for example, rupees 85.20. Okay. So now there is a certain change in the Forex rates, which is happening over a period of year. You can see over here, these exchanges terms of, which is the quoted currency over here. Quoted currency is dollar, right? Quoted currency is dollar and pricing currency is basically rupees, right? So here, since $1 price is increasing from 81.50 to 85.20, so that means which currency is appreciating? Dollar is appreciating and INR vis-a-vis dollar is depreciating, right? So what is the change in the currency rate over here? What is the change in the currency rate over here? Yes. Can we calculate that? How do we calculate that? 85.20 minus 81.50 upon, what was the original quote? Original cost was 81.50. Am I right? So this turns out to be how much? 3.70 upon 81.50 into 100. So how much percentage is this? Something like 3.20. So I think it is 4.5 something, right?
4.54.
Okay, thank you. So 4.54%. So if you are a person or we are a person who have invested in share in Tesla, how will that work? Essentially, at the beginning of the year, say for example, even for one share, what you would have done is you would have purchased first and foremost foreign currency. So you have paid 81.50 into 50, right? To acquire one share of Tesla at $50. At the end of the year, you got $60, which is the price, plus 2.50. So you convert that into INR at which rate? At 85.20. Then you compute your ROI and you will get your ROI, which is comprising of two aspects. Which are those two aspects? One is your return earned by the stock And second one is return earned by the foreign currency, right? So how do we calculate this? It is called factor on factor, right? So how do we calculate this? Return will be computed how? It will be computed as 1 plus return on FC. So whatever is the foreign currency stock over here, right? That multiplied by 1 plus your change in the forex rate, right? Which is this appreciation, return on forex minus 1. Minus 1. So how much will that turn out to be? 1.25 into 1.0454 minus 1. You can see the benefit of compounding is happening automatically. You are not only earning 25% over here, but you are also earning this 4.54% on the entire investment of 1 plus the 25% return you have earned. And thereby, your return is bound to be something in the region of around 30% something, right? 30 point, I think it is coming something like 30.675. Right? So you have 30.67% as a return which is happening, right? So this is the formula that we had done. We had also solved it in a longer format also. However, this being the revision section, I would obviously encourage you, if you feel, then you can please go and refer to that particular entire session, right? We had done 6 sessions on this particular module. And considering this particular module is very, very significant from even examination perspective, right? And also from your practical learning perspective. So it will be in our interest to essentially go and refer to that, right? Now, after this, I'm going to give you one example over here. So, say for example, there is a US investor, okay? There is a US investor who has invested in, say, UK equities. Has invested in UK equities. Return on UK is expected to be, say, for example, 7%. Return on, say, for example, the forex part is expected to be 4%. Can you tell me what is the total return which will be earned by the US investor in dollar terms? Try doing that, right? I will also obviously calculate over here. So calculate return on US currency, right? US currency. Now you can see over here, there is no forex rate which is being provided to you over here. And we don't even need forex rates over here, because what we are asked is return on US, because a US investor is investing in UK equities. The return on UK equities is 7% and return on FX is 4%. You can see it is positive, which means the return on forex is positive. What does that mean? Percentage change in dollar terms is positive, right? So let's say this is dollar upon pound, okay? In that case, what will be the return on US which will work? 1.07 into 1.04, using the same concept, right, which we have just learned, minus 1.
Yes, sir.
So I believe the return should be, how much will be the return? Any ideas? Would it be 11%? 11.28%. Okay. Thank you. Thank you very much. right? So this is a concept of factor on factor benefit which we get. And when we are trying to calculate what will be the return on our domestic currency, right? So it depends on, here it was a US investor. Had it been the other way around, then obviously the computation would have changed slightly, right? Now, when now we are converting, say for example, again I will take over here one example to explain our concept. Say I have GBP 50,000, okay, and £1 is equal to $1.7650. So then, how much will be GBP $50,000? So how do we go about computing that? Because here now we are expressing this particular currency exchange rate. This exchange rate has, what is the quoted currency over here? Quoted currency is pound.
1.7650.
Quoted currency is also known as base currency, right? So here when you are saying it this way, it basically means it is 1.7650 upon 1. So what is your 1? 1 is your pound, right? So your quoted currency or base currency is pound, and dollar is your pricing or reference currency. Now in this particular case, do I multiply or divide to get what will be the total dollars required, or how much dollars will I get? Yes, if I sell my GBP 50,000, how much dollars will I get?
Multiply.
I will have to multiply, right? Because here it is GBP 50,000, and you can see over here my quoted currency is essentially per pound basis, right? So I can directly multiply 50,000 into 1 point. So dollars will be how much? 50,000 into 1.7650, and whatever that amount turns up to.
88,250.
88,000.
250.
250? Okay, 88,250.
Yes, sir.
Right? So this is something which we need to understand. How do we go about converting the exchange rates? Now, before
can you clarify this? Why did we divide? Oh, multiply, sorry. Not divide.
Okay. So which is the quoted currency? Did you understand the concept of quoted currency over here?
Yes, sir.
So your quoted currency essentially meaning if you want to buy, say for example, £1, you have to pay how much dollars? 1.7650. Are you with me?
Yes, sir.
Okay. So if $1, let's say I put it over here, dollar and pound. We chartered accountants generally we do this particular calculation often. Remember? So £1 is going to cost $1.7650. Am I right?
Yes, sir.
50,000 will cost how much? Is this particular expression familiar to you? The way I am expressing over here?
Yes, sir. Yes, sir.
So 50,000 into
Cross multiplication.
1.7650 divided by 1. Does that make sense now?
Yes, sir.
Okay. All right. Now, I want to understand over here when I'm expressing how would a division work. So say for example, let me take another example because before I go to the next part, I need to have this particular clarity about multiplication and division. So say for example, JPY I have is say for example 1 million, or in other words 10 lakhs, right? And I'm saying 1 INR 1 is equal to JPY 2.3650. Okay. So JPY 10 lakhs, you are given the INR rate. INR 1 is equal to JPY 2.3650. So if you sell this JPY 10 lakhs, how much INR can you expect?
10 lakh divided by 2.3650.
Yes. Again, we can, if you are not able to follow, you can do the same thing again, right? JPY and INR. INR 1 is 2.3650. Here you have 10 lakhs. So INR how much? Cross multiplication. 10 lakhs into 1 divided by 2.3650. Right? So that will turn up to something like maybe 400 and maybe 22,000 or something like that, right? 832.98. Okay, this is the answer which is coming as per my calculation over here. Okay, now once we have understood basic exchange rates, now I will introduce the concept of spot rate and forward rate. Spot rate and forward rate.
Hello.
Yes. Hello. Are you able to hear me? Am I audible?
Yes. Yes, sir.
Okay. All right. So now we are going to consider spot rate and forward rate. What do you mean by spot rate? Spot rate is the rate at which I can buy a particular foreign exchange today, right? So say for example, I am told $1 is equal to, let's say 85 rupees, okay? 85 rupees. This is the rate happening today. Now, normally in India, spot rates are always quoted on T+2 basis. Reason being because even for conversion purposes, even if you have cash available, say you have been abroad, you have come back, you have got $2,000, you want to convert that, then whatever is the prevailing date today, out of that they are going to basically discount it for the 2 days which you will have to essentially wait, because normally spot rate conversion takes about T+2 time. So you will get the money today because you want the money today, so they will give you today. But whatever is the rate, in that they will generally, for every day that you essentially pass through, it will essentially say 2 or 3 paise extra charge will be levied on it by the intermediary, also known as forex dealers, right? Because if you do not want any discounts, meaning, say for example, I am giving today $1,000 to my forex dealer, that you take $1,000 and you give me 85,000 rupees. Then my forex dealer will say, if you want entire 85,000, then sir, I will give you after 2 days. Because the spot rate is generally for T+2 period. If you want today, then there will be a certain discount charge which will be applied on it. Right? For our example purposes, we may obviously not have this particular aspect coming up, because most of the times you will find, we will say generally, assume there is no brokerage, etc. Assume there is no taxation, etc. But in practical life, as you know, you will have those particular aspects also coming into your computation, because your transaction cost has to be considered by you, right? But right now, for the purpose of brevity and for the purpose of concept understanding, we will say $1 is 85 rupees in spot market. And say 1 year from now, so 1 year forward rate, meaning 1 year from now, if you were to say, for example, buy or sell $1, it will be rupees, let's say 90, right? It will be rupees 90. What does that mean? What does that mean? Today, the currency, $1, is available to you rupees 85, right? So 1 year later, you are expecting it to be available at rupees 90. So for brevity purposes, again for easy reference purposes, let us consider this dollar is not a dollar, but it is, say for example, potato. So one potato is going to cost you today 85 rupees, and after 1 year, it is going to cost 90 rupees. So can you tell me, which one is becoming or appreciating? Is the INR appreciating or is it the potato which is appreciating? 85 is becoming 90. Right?
Potato.
So it is a potato which is appreciating. Now remember, I replaced potato in place of dollar because dollar I was treating. Sometimes students often when they use the currency, they get confused. But remember in direct quote, basically dollar is nothing but just another commodity, but it is a foreign exchange commodity. That's the only difference. So it is dollar which is appreciating, right? Dollar, US dollar is appreciating, which means INR is rupee vis-a-vis dollar is depreciating. Am I right? Now the question is, what is the percentage of appreciation?
5.88.
And how do we calculate that? How do we calculate that?
85 minus 85
Remember
minus
in the
90
numerator
divided by
any which way there has to be the difference. 90 minus 85. Am I right? Numerator will have to remain 90 minus 85. No change whatsoever
Yes.
in that. It's only the denominator. What will be the denominator? The denominator for the quoted currency. Quoted meaning here we are talking about potato. So potato ka original price. What is the original price of potato? 85 rupees. So it will be 85 spot price. Right? So you will say it will be 5 upon 85 and whatever that percentage turns out to. How much is that turning out to, my friend? You said
5.88. 5.88.
5.88%. Right? This is the percentage appreciation. Okay. Now I want to calculate what is percentage depreciation because appreciation was pertaining to dollar currency, right? Now I want to calculate what is percentage depreciation. So that is for rupee. How do I calculate that? Yes, again, numerator has to remain the same. 90 minus 85. Right? I already know this is depreciation, so I don't need to worry about putting 85 minus 90 because automatically I know this is depreciation, so it is a negative. So 5 in the numerator will remain common. What about denominator?
90.
It will be 90. Why? Why do you use spot rate? We use spot rate when the currency is, you are calculating basically for quoted currency, right? Which is the quoted currency over here? Quoted currency is dollar, right? Base currency is dollar. So whenever it is for the base currency, then in the denominator you will take spot rate. And whenever you are calculating for pricing currency or reference currency, then in that case, you will essentially take forward rate in the denominator. Are you with me?
Yes, sir.
All right.
Yes.
Now with that,
5.55.
I'm sorry,
5.55.
5.55%. Now remember, this is appreciation, so this is going up, this is depreciation, okay? Now in the examination, generally, you have to protect your interest, right? The person at the other end should not feel that, when I calculate, I have calculated the entire thing and I did not get the marks. It should not happen. So how I have protected myself? See, I have written over here depreciation. And that is the reason now I can write in the numerator 90 minus 85. Because you will find in the module where they have essentially mentioned it should be the other way around, right? 85 minus 90. So in order to protect myself, what I have done is, for my easy memory purposes, in the numerator, I am always going to take the difference. So I keep it very simple, 90 minus 85 in the numerator. If it is appreciation, it is positive. If it is depreciation, it is negative. So I don't have to now worry about the sign of the numerator. It becomes fixed variable for me. What I essentially consider over here is depreciation. And this is how I protect myself in the examination, right? So I'm writing over here 90 minus 85 upon, since it is pricing currency, so I write forward rate. Here it is quoted currency, so I write spot rate. Are you with me? Right?
Yes, sir.
Okay.
Excuse me, sir.
Yes, dear.
इसके पहले वाला कॉन्सेप्ट आप इनका समझा देंगे.
Which concept are you referring to, my dear?
Just before this concept. Earlier. आपका earlier slide एक बार वो पढ़िए. हाँ, this one. ये जो example 2 है ना, वो एक बार.
This was basically about if Japanese yen is available to you, you have Japanese yen 10 lakhs available with you, and you are given the exchange rate INR 1 is equal to JPY. Right? So how do you basically, should you multiply or should you divide to find how much rupees you will get? Because when you surrender JPY 10 lakhs, you will obviously ask for INR in return, right? So how much INR can you expect? So easy way to calculate is, you can see over here, JPY INR. 1 INR is JPY 2.3650. Now you have 10 lakhs, right? If you have 10 lakhs JPY, how much INR will I get? Question mark. So I can do simple cross multiplication. 10 lakhs into 1 divided by 2.3650.
Thank you, sir. Thank you.
Right? This is something that we have been doing in a lot of our accounting concepts as well, right? Cross multiplication, etc.
Yes, sir.
All right. Now, I'm going to take one example. So, my spot rate today is expressed as CHF 1.6520 upon euro, right? Per euro. My spot rate after a year is expected to be CHF 1.5990 upon euro, right? So first and foremost, what is the base currency over here? Yes. Question, base currency. What is the base currency?
Euro.
Euro is the base currency. Yes, that is the correct answer. You can see over here, it is for 1 euro, right? So it is a base currency. All right. Now, CHF currency is depreciating. True or false? True or false? Tell me. Which currency is depreciating over here? And which
Euro
currency is appreciating?
Euro is depreciating.
Euro is depreciating, right? As I mentioned, whenever you talk about quoted currency, you should always consider euro as good as a potato.
Potato.
So potato was earlier costing you 1.65, now it is going to cost you 1.5990. So potato has become cheaper, which means it is depreciating. So CHF is appreciating, right? So here the correct answer would be CHF is not depreciating, it is appreciating. So is this sentence correct? No. This is false, right? Because CHF is appreciating. Now, can we calculate what is the percentage change in euro and in percentage change in CHF? What is percentage change in euro? How do I calculate that? Remember, I am always going to say
1.6520.
1.5990 minus 1.6520. Or I can write the other way around also. Okay, the difference will be there. By the way, this is appreciation or depreciation? Euro, you know, is depreciating, right?
Yes, sir.
All right. So in the denominator, I will write which price? Spot rate current or spot rate 1 year from now?
Current, sir. 1.6520.
You will have to take the base price, right? Spot rate in the current times, not 1 year later. Now, this is the reason why I have taken this particular example where I have mentioned over here S0 and S1. In the previous example, I had mentioned over there S0 and F0, spot rate and forward rate. But here I have given you spot rate at the year 0 and spot rate after the year. So a lot of the time students get confused just because both are spot rates, sir. How do I go about it? So it has to be always Remember, for the quoted currency, you always have to have the denominator, which will be spot rate original, right? 1.6520 into 100. So how much?
58.59.
30?
58.59. 58.
58.59.
59.
58.59.
No, sir, it's
58.59%.
3.21.
No, this is too much. It can't be. How much is the
3.21.
3 point?
21.
3.21, sorry.
3.2, sir.
58% can't be there, na? Because it has to then become half of it. Okay, so here it will be 3.21%. Now, how much will be the percentage change in CHF? Again, same thing, I can keep the numerator same, 1.5990. Now, remember, this is appreciating, okay? This is appreciating. So, this is 3.21, where it is going down. Here, I will again say 1.5990 minus 1.6520. Because it is a pricing currency, I will always mention the forward rate or 1 year after spot rate, right? So here it will be
3.31.
1.5990 into 100.
3.31.
3.31 percentage. Okay. Now, if I want to calculate one from the other, say for example, you are given the rate of appreciation in one currency and you want to calculate the other one. How do I go about it? What is the easier way to go about it? Now, here the numbers are a bit decimal. So, since I am talking about the concept, let me take the easier number, for example. Okay. All right. Say, for example, 1 pound is equal to rupees 100. Okay. This is spot rate. And 1 year forward rate is 1 pound is equal to rupees 105. So, which currency is appreciating? Yes, which currency is appreciating?
Pound.
Pound is appreciating. Remember, pound was earlier 100, now it is going to cost you 105. So, pound is appreciating. So, percentage appreciation in pound will be how much? 105 minus 100 upon 100.
5%,
Right?
sir.
5%.
5%.
Yes, sir.
Okay. Now, I want to calculate percentage depreciation from this 5% directly. Here, so you are given 105, 100, etc. But say, for example, this is not given to you. Directly, you are told percentage appreciation in pound is 5%. Calculate how much will be depreciation percentage in INR. Then how do you find it? Yes, from appreciation to depreciation, how will you find it? So 5% was the appreciation, right? After appreciation, how much has become the, what is the base now? 100 or 105?
105.
105, right? Into 100. This is how you find percentage.
4.76.
4.76%. Say, for example, if this was percentage depreciation. Say, for example, the percentage depreciation was 5%. And now I have to calculate, let's say, percentage depreciation. We already know percentage depreciation, right? So, from percentage depreciation, I want to find percentage appreciation. Then how will I go about it? Yes. So, percentage appreciation, calculating it from percentage of depreciation. So, I will say 4.76.
76 divided by 100 into 105.
4.76 depreciation, 100 would have become how much? 100 minus
divided by 100.
95.24. Are you with me? Are you able to follow? I repeat once again. Percentage depreciation is given to you as 4.76%. From this, I want to calculate how much is actually the percentage appreciation. So, if the depreciation is 4.76, which I already know. So 4.76% is the depreciation percentage. So what is the denominator? Whatever was 100 earlier now has become how much? 4.76 less. Am I right? So the denominator over here is 95.24. So the currency, opposite currency, has appreciated by 5%. Are you all getting 5%? Check, please. Are you getting 5%?
Yes, sir. Yes, sir.
Right? Okay. Hello? Got it?
Even, sir, I tried in other way. Like, I have just multiplied 4.76 into 105 divided by 100. So I also received the same data.
Yes, same
Just
same way I
multiply.
have calculated.
So this is not the only method. As long as you are getting the correct answer
Okay.
with
It is
your
not
methodology
giving,
also, it's completely
it is
okay.
not giving exactly 5%.
That's okay. That's okay. Because of the rounding of factor will be there. Na? So we are taking over here when we have taken 4.76%, we have rounded off to the 2 decimal points. Remember? If you take the precise answer, then you will get precise answer of 5%.
Okay.
Because this 4.76 has been rounded off, remember? 5 upon 105. So you have rounded off that number. It is not precisely
Yes.
4.76.
Yes, sir.
Right? So that is the reason you will not get a precise 5% when you try to go back to that. All right. Now we are going to start with the concept of two-way quotes. We have so far learned about what is Forex quote, where we had only a single quote, but now we will have a two-way quote, right? What do you mean by two-way quote? All right. So what do you mean by
Spot trade
two-way?
and forward rate.
I'm sorry?
Spot and forward.
No. You're not talking about spot and forward rate. Two-way quote essentially, say for example, today if you want to buy a US dollar, okay, then generally your bank is going to quote you $1 is equal to rupees 85, rupees 87. What does this mean?
Okay, buy and sell rate.
Yes. So this is your what we call as bid rate, and this is what we call as ask rate. Right? Now, bid rate is the rate you can see over here. If you are a banker, say for example, you yourselves are a banker and I am your customer, I am coming to you to sell my dollars. I want to sell my dollars to you. Will you buy my dollars at 87 or 85? Considering these are the two prices which are available. Which price are you going to give me? 85 or 87? Because if you are going to buy at 87 from me and you are going to sell at 85, you will end up making losses.
Yes, sir.
Right? And bank obviously has to make some margin in between. So it is going to buy cheap and sell slightly expensive, right? With their margin. So here you will find bid price is the price at which bank buys, right? So bid is nothing but the buy price for the bank. But we generally, for customer, for me, it is sell price, right? So if I want to sell my dollars, then I will get 85. This is from whose perspective?
Customer.
This is from customer's perspective. So bid price becomes my sell price. This is from the customer perspective. From the bank perspective, bid means buy. But for the customer, bid basically means it is a sell price. Are you with me? Because if I have to
Yes,
buy,
sir.
I will have to buy at ask price. And bank is going to basically say, bank is going to sell me at this price. So whenever we generally mention about bid or ask, we always say bid is sell, ask is buy. Why? Because we are talking from customer's perspective. Okay? We are not talking from the authorized dealer perspective or from the bank's perspective. So from customer's perspective, bid is sell and ask is buy. So if I have to buy, I will have to buy at 87. If I want to sell, I will have to sell at 85. Are you with me? Right?
Yes, sir.
What is the difference between 87 minus 85? What is this 2 rupees? Yes, what is this 2 rupees? This is known as spread or the margin. Right? Are you all with me?
Yes, sir.
Okay. All right. Now, we had earlier also mentioned the difference between direct quote and indirect quote. Remember? So here I will again explain over here just in brief. What do you mean by direct quote? So if I am saying over here $1 is equal to rupees 85. So how will I express this in indirect quote?
1 divided by 85.
The difference basically you need to understand is here it is $1 is 85, meaning it says it is 85 upon 1. In other words, it is saying it is rupees upon dollar. So indirect quote is nothing but the inverse of this, right? It is going to say dollar upon rupees. So here you are going to essentially say $1 upon 85. Inverse of that. That is your indirect quote. Right? Inverse of direct quote is your indirect quote. Now, since I have a two-way quote, how will I do the indirect? From direct to indirect. I have this quote available to me. I have already got this two-way quote available to me where I have the bid price and I have the ask price. I want to convert this into indirect quote. I want to convert this into indirect quote, but a two-way quote. I still want a two-way quote, not a one-way quote. This was a one-way quote over here, just a single quote. Here I have two-way quote, which I want to now convert into indirect quote. So how do I do that? How do I do that?
Then आपका bid होगा 1 divided by 87 और ask होगा 1 divided by 85.
Yes. So your bid will become your ask and ask will become your bid, but inverse of the same, right? So bid will be inverse of the ask, meaning it will be here 1 upon 87, and in the ask will be inverse of bid price, it will be 1 upon 85. So $1 upon rupee 85, and here it will be $1 upon rupee 87. I repeat once again, two-way quote. When you are trying to inverse that or convert it into indirect quote, so your ask price will become your bid price, but it will be inverse of the ask, right? So my bid over here will be inverse of the ask, and ask price over here will be the inverse of my sell price. Okay. Now, let's take one example where, say for example, I want to convert, these are the quotations which are available right now. So I am told ₹85, ₹87. 1 pound is equal to $1.25, $1.30. Okay, all right. This is my fresh question. $1. The quotations which are given, two-way quotes are given to us. $1 is rupees 85 to 87, and 1 pound is $1.25 to $1.30. You have 1 crore rupee. Okay, so how much GBP can you get? That is the question. How can I go about this? Yes. Here you can see over here, there are two quotes which are available. In the first one, the quoted currency or the base currency is dollar, right? Dollar to rupees. In the second one, the quotation is base currency is pound. However, the quotation is mentioned in dollar terms. So the pricing currency is dollar. So direct quote of rupee to pound is not available. And I have to essentially convert my 1 crore rupee into GBP. So are you going to buy GBP or are you going to sell GBP? What is it that you want?
Buy GBP.
Buy.
I want to essentially buy GBP. So I am trying to find over here what will be the quotation of rupee upon GBP. That is pound. Yes. How can I find that? By the way, do you want to buy, meaning I will buy it at, I am the customer, remember? So I am going to buy at which rate? Bid rate or ask rate?
Ask rate.
Ask rate, right? So because I want to buy GBP. To buy GBP, you need to have dollar. I don't even have dollar. So what I will have to do over here is, first of all, I will have to buy dollar. Am I right? I will have to first of all buy dollar. Do I have dollar rate over here available to me? Yes. Is that available to
Yes.
me? Rupee upon dollar rate is available. Am I right? So I am going to buy first of all dollar. And then I will use dollar to buy pound. Are you with me? So you can see I have to essentially buy, meaning ask. I want to find what is the rupee upon pound ask rate. So I'm going to over here use rupee to dollar ask rate multiplied by dollar to pound ask rate. And why am I using only ask rate over here? So whenever you are doing multiplication, for simple memory purposes, you can always say that whenever you have to convert, it always has to be ask rate into ask rate to get the ask rate. However, why? What is the logic? The logic is basically because first of all, to buy pound, I will need to first of all buy dollar. So that is ask rate. And then I need to again buy pound. So I'll have to convert that into ask rate. Now, question is, do you have these rates available to you? Check it out. Which is the rupee upon dollar ask rate? Do I have rupee upon dollar ask rate? Yes. That I have.
Yes, 1 divided by 87.
Do I need to do 1 upon 87?
No, sorry, 1 divided by 87.
87? No, I will just write 87. Because it is dollar, right? So it is 1. Already quoted currency is dollar over here. So I don't need to convert that. What about dollar to pound? Is it available to you, dollar to pound? Here again, your quoted currency is pound, right? So pound is already in the
Yes.
denominator.
1.
So numerator has to be how much? 1.25 or 1.30?
1.30.
1.30. So 87 into 1.30 will be how much? Another 24 rupees or 24? Yes. How much is that coming to? 90 rupees, whatever it is.
1.1.
I'm sorry?
113.1.
113.1%.
1.
Sorry, 1. This is 113.1 rupee per pound. This is the rate of rupee upon pound, right? 113.1. This is known as cross rates. What is this known as? Cross rates.
Cross rate.
When directly two currencies are not being quoted, so you have to essentially triangulate it using a common currency in between. That is the reason this is known as cross rate. I repeat once again for easy reference. Remember what is cross rate? I have the rates given over here in terms of dollar. Rupee to dollar is available and dollar to pound is available. So rupee to pound direct quotation is not available. So what I did was I essentially converted first of all from rupee to dollar and then dollar to pound to get the cross rates. This is the ask rate which we have done. Can you similarly do a bid rate as well? Can we do the bid rate as well? Yes?
Yes, sir.
So rupee upon pound, meaning 1 pound is equal to 113.1. This is rupee 113.1. 113.1 rupee. This is the ask rate. Can we also find the bid rate over here similarly? Can we do the same process? How will we do that? Yes. It will be 85 into 1.25.
1.2.
85 into 1.25. So how much will that come to?
106.25.
106.25
25.
or 15?
25.
25. Okay. So this is my bid rate and ask rate based on cross rate computation, which we have done. Right? Now, we have shared one question sheet. I believe all of you must be having the question sheet for the revision
Yes,
lectures.
sir. Yes, sir.
Right? Let us solve one sum on that and see whether what I have taught over here right now as a concept, does it make sense for you? Are we getting it? I think this is the question for question number 1. Is everyone able to see that? Visible to everyone?
Yes, sir.
Question number 1, you have following two-way quotes appear in foreign exchange market. So you have the spot rate and 2 months forward rate is available to you. Rupees to dollar. So here again, what is the base currency? What is the base currency?
Dollar.
Dollar. Spot rate is 46 to 46.25 and 2 month forward rate is 47 slash 47.50. So you are given the bid and ask rate for both spot and forward. We are required how many US dollars should a firm sell to get 25 lakhs after 2 months? How many US dollars should a firm sell to get 25 lakh rupees after 2 months? Yes. So I want 25 lakhs. So am I going to buy currency or sell US dollar?
Buy US dollar.
Are you going to buy? How many US dollars should a firm sell? So you're going to sell dollars, right?
Sell dollar, sorry.
You're going to sell dollars. Okay. So selling means I will essentially sell at what rate? 47 or 47.50?
47.
At 47. So how many dollars would you require? 25 lakhs divided by 47. So you will get
53,191.
53, 1,
191. 91.
1. Okay.
0.49.
53.49. Okay. So $53,191 I will get, which I need to sell to get 25 lakh rupees. That is the first question. Second question. How many rupees is the firm required to pay to obtain US dollar 200,000 in the spot market. Now, how many rupees is the firm required to pay? So you have to pay rupees in order to buy dollars, right? This is the spot rate which is available. Bid and ask. Bid is the price at which you sell. Ask is the price at which you buy. You have to buy how much? I have to buy $2 lakh. Am I right? So for $2 lakh, I will have to pay how much?
46.25.
So how much will that come to?
92,50,000.
92 lakhs 50,000.
Yes.
And I say it is 92.50 lakhs. Right? All right. Now the third one. Assume the firm has US dollar 69,000 in current account earning no interest. ROI on rupee investment is 10% per annum. Should the firm encash the US dollar now or 2 months later? Yes. So how do I do this? Yes. What is the question over here? Have you all understood? Whether I should sell the money, US dollar 69,000 today in spot market, or should I do it 2 months later? So say, for example, I will take the first option. I'm selling in spot. Okay. Let me sell it in spot. In spot, if I sell it right now for $69,000, I will get how much rupees? What will be the rate I will
46.
get? I will get
46.
So that will come to how much amount?
31.74
74.
lakh.
31.74 lakhs. Right? Now, since I have got rupees, I will obviously not keep it idle. I will invest it and I will earn interest or return, ROI. Right? What is the ROI going to be? 31.74 lakhs into 10% return, right? But this is 10% per annum. 10% into, I will earn for how many months? Only 2 months, am I right? Because I want to do the comparison for, should I sell it today or should I sell it 2 months later? So in 2 months time, how much interest?
52,900.
How much will that be?
52,900.
52,900. Am I right?
Yes.
52,900. Okay. So total turns out to be how much? 31.74 lakhs and then 52,000. So I believe this becomes 32 lakhs.
0.269.
0.269. Right? Now, what is my second option? My second option is selling in forward. Yani after 2 months. Right? Forward 2 months. Forward. If I sell 2 months forward, what is the rate I'm going to get?
47.
I will get 47, right? So here I'm going to say I'm going to get $69,000 into 47. How much will be the amount?
32.43 lakh.
32.43. So which is higher, 32.269 or 32.43?
32.43.
So which option will you opt for?
After 2 months sale.
Selling forward after 2 months. Am I right?
So
All right. Now, since we have already discussed two-way quotes, let us consider another opportunity when we talk about, we have discussed now two-way quotes, we have discussed cross rates. So let us also now discuss if there is an arbitrage opportunity available in the cross rates. How do I essentially consider an arbitrage opportunity? Yes, how do I consider that? Any ideas? What is the meaning of arbitrage? Yes, anyone? What is the meaning of arbitrage? Arbitrage is nothing but riskless profit. Am I right? So say, for example, I am given the information over here that my spot rate is $1 equals to rupees 64. Okay. Forward rate after a year is $1 is equal to rupees 65.90. Return in return return on USD is 7% and return in on rupee is, say, for example, 12%. Is there any arbitrage opportunity available over here? Spot rate is $1 is equal to 64. Forward rate is $1 is 65.90. Return on USD is 7% and return on rupee is 12%. So how do I go about this? Now there are two ways of it. You can say, for example, you can start that, okay, I have, let's say, for example, $100. Okay. So I will borrow $100. Let's say you borrow $100. Okay. After a year, you will have to pay it with interest, right? So you will have to pay $107. When you get this $100, you convert it today into INR. So convert to rupees today, right? At what rate? At spot rate. So you will get how much? 6,400. Are you with me? Now, a year later, your investment will grow into how much? So a year later, right? So at forward rate, sorry, a year later, it will become how much? One year later, it will become 6,400 into 1.12 because it will earn 12% return, right, in India. So that will become what? 7,000. 7,160.
100.
Right. Okay. Now, at the end of the year, I get 7,168. So I will again convert this to, I have to convert this into dollar, right? Because I have to repay the loan. So for dollars, 107, how much do I need? How much I would need to pay off $107? I would need to pay it at 65 point. Do I need to pay it at 65.90? Yes.
Yes.
So, 65.90 × 100 is 1 lakh. 1 lakh. 1 lakh is 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 1 lakh. 1 lakh at 65.90. How much will that turn out to?
7051.3.
7051.3.
3.
Okay. So I convert this. In other words, I have bought this $107 and then I will settle the loan, pay off the borrowing. Have I made any money over here? Have I made any money over here? You can see over here 7168 minus 7051.30. So what is the difference? Whatever is the difference over here.
116.7.
116.70. This becomes my arbitrage gain. Right? So this becomes my arbitrage gain.
Sir, does that mean that when return on USD is less than return on Indian rupees, mota moti, can we say that we should borrow the money in US dollar and then after 1 year, in forward market, we should get so that we have arbitrage profit, arbitrage gain, or not necessarily?
Other things remaining same, then yes, but there is one challenge over here. See, your forex rate is also going to have a depreciation, right?
Yes.
So if you will, we have learned about that in a separate concept where we determine how the forex rates are being determined, right? So you have a principle of interest rate parity, purchasing power parity,
Yes.
right? So since, let's say in India, let me just briefly touch upon that concept since you have mentioned. So say for example, today, say for example, I have 100 rupees. Okay, let's say I'm taking over here 100 rupees is equal to, let's say, $1. This is just for the ease and reference. Okay, so let's say today this is the rate. Now, after a year, my rupee is going to earn, say, for example, 12%, so it will become 112. And in US, you are going to earn, say, for example, 7%. So this will be 1.07. So as per the interest rate parity principle, what it says is that a year down the line, the same principle of parity should be prevailing, meaning the new equilibrium will be $1.07 is equal to 112 rupees, which means dollar per se will appreciate and INR will depreciate. Are you with me?
Yes, sir. Got it.
Got it? Okay. All right. So we cannot say about any particular single concept in isolation. We have to consider all the aspects.
Okay, sir. Thank you.
Now, I take one more concept on arbitrage, and that is essentially how we basically compute incorporating this interest factor as well, right? Since we have just spoken about that interest factor, so how the arbitrage opportunity works in international transactions per se, especially for forex transactions. So we have something known as fair forward rate. So there is something known as actual forward rate. Okay. And there is fair forward rate. What is the difference? Actual forward rate is actually given to you by the banks. So banks basically provide you what is the actual forward rate. Fair forward rate is basically being determined by you based on the difference of, let me take an example of, let's say, interest. We were just talking about interest rate. So let me take about interest rate. So say for example, here we had taken that spot rate was 100 rupees. Remember? So say for example, 100 rupees is my spot rate. Interest in India is how much? 12%. And this 100 rupees, this is rupees, right? 100 rupees, because it was 100 upon dollar, right? 100 upon dollar. Let me put it that also here, just for your easy reference. So my exchange rate or the spot rate is 100 rupees upon $1, right? Where my 100 rupees is going to increase by 12%, which is the rate of return in INR terms. And dollar is going to grow at what rate? 1 plus 7%. Are you with me?
Yes.
So according to the interest rate principle, what is the new forward rate which is coming out now per dollar? What is the new rate which is coming out? 100 into 1.12 upon 1.07. So what is this new rate coming out to? Can you do the calculation? Yes. How much is that going to come to?
4.67.
Sorry, 100 and
4.67.
104.67. Now this is the fair forward rate which I have received for rupee upon dollar based on the interest rate differential between the two economies, right? In rupee and dollar respectively. Now say for example, the actual forward rate which you are getting, you have computed this. So we as chartered accountants, we have computed that for our client or for our customer, right? Because we are the entity, we are working with the entity. This is what we have computed. This is the fair forward rate. Now the actual forward rate which the bank is giving you is, say for example, 104 or say for example 106. Either ways, I have taken two examples, okay? 104 and 106. So what happens when there is a 104 and what happens when there is a 106? The question over here is there a possibility of an arbitrage opportunity? As long as fair forward rate and your actual forward rate are not same, they are different, there is an arbitrage opportunity in the same. Can you tell me what is the arbitrage opportunity available when the rate is 104? So fair forward rate is 104.67, while actual forward rate which is quoted by the bank is 104. So bank is essentially saying that dollar is, they are quoting dollar 1 year later at a discount. Am I right?
Yes.
So what could be my strategy in that case? Which currency should I buy and which currency should I sell? Tell me. What will be my strategy over here? What will be my arbitrage strategy over here? I repeat once again, my fair forward rate is 104.67 1 year from now, and my actual forward rate which is quoted by the bank is 104. Right? So there is an arbitrage opportunity. The question is yes or no, and the answer is yes. Why answer is yes? As long as these two values are not same, they are not identical, there is an arbitrage opportunity available. Right? So this is not the same value. You can see there is a clear difference of 0.67. So there is an arbitrage opportunity available. Now the question is, what is your strategy? What is your strategy? So tell me, which currency is quoted at discount? Which
Rupees.
currency is quoted at discount?
Rupees.
No.
INR.
Quoted currency kya hai? Which is the quoted currency? Dollar, right?
Quoted currency is, yeah.
Quoted currency is dollar. You can see over here 104.67 should be the fair forward rate, but it is quoted at 104, meaning dollar is quoted at discount. So in future, if you keep dollar in your pocket, in future, 1 year down the line, that will actually lose its value compared to fair forward rate. So what should you do? What is the better way to go about it? Yes, what should I do?
Sell the dollar now.
Exactly. So my strategy over here will be sell dollar in spot. Right? Today, I will sell it in the spot and then I will buy dollar in AFR. AFR stands for actual forward rate. So I'll buy dollar in AFR, meaning I will enter into an agreement with the bank that I will buy from you whatever amount of dollar. Say, for example, let's take the example to be that the dollar which we are going to transact is, say, for example, $1 million. Okay, 1 million USD. That is my transaction size. Now, what is the amount of gain which I will make over here? Arbitrage gain over here. How will you go about this? To sell dollar in spot. Yes, tell me. How do I go about it?
It will be 0.67 into 1 million.
But will that transaction happen that way as a process? It will definitely be 0.67 into 1 million, right? Because that is the difference which is going to come through. But what will be the process? How you will have to go through? You need to sell dollar in spot, but I don't have dollars right now. So what I will do is I will borrow dollars, then sell that dollar in the spot market, convert that into INR. I'm saying out these steps bit slightly faster. It is available in your module as well, I believe. And we had also discussed this in the previous sessions as well, right? In the second session, which I had taken earlier in December, you'll find it over there as well. But I'll repeat once again. So what is the best way to go about it? First of all, I don't have dollars today, right? So what I will do is, I will first of all
Borrow dollar.
borrow dollars,
Borrow dollar.
right? Then after borrowing dollars, what I will do? Convert to rupee. Then what I'm going to do after converting to rupee? I'm going to on return. How much return percentage I will on? 12%. Are you with me?
Yes.
Yes, sir.
Okay. Then at the end of the year, what I will do is, I have got rupee, I have got the return also. So then I will buy dollars. Am I right? Because I will need to pay money. So there is one step over here which I have missed out, in fact. And that step is basically a very important step. What is that? Borrow dollar, convert into rupee, and most importantly, you need to
Invest.
buy forward contract, right? You need to buy forward contract, right? AFR pay, you will have to enter into this contract with bank, right? Then you will earn return of 12%. At the end, you will buy dollars. And remember, when you try to pay back the loan, you will have to pay the loan how much? Not just 1 million, you will have to pay along with 7% return also. So you will pay 1.07 million. Right? The difference will be your profit arbitrage gain. How much will that be? 1 million USD into 0.67. Are you with me?
Yes, sir. Got it.
Okay. Now say, for example, at the same place, if we say the rate is going to be 106, you see, your fair forward rate is 104.67, and the bank is saying that the rate is going to be 106, which means which currency is trading in discount now? Fair forward rate is 104.67 1 year from now.
Rupee.
But dollar is quoted at higher price, meaning dollar is going at premium 1 year from now. Meaning INR is depreciating, right? So what should I do in that case? The entire strategy will have to be reversed, right? So what you will do is, you will buy dollars in spot, right? And then you will sell dollar in forward. Got it, everyone?
Clear to me, sir.
Okay. Since we have discussed this concept, it's half time, but shall we please solve one question and then we take a break?
Yes, sir.
So we have one question number 3. question number 3. Wait a moment, let me take that question over here. Question number 3 in your revision assignment, which I have shared with you. This is one question, question number 3. Following are the spot exchange rates quoted at 3 different forex markets. USD to INR is 48.30 in Mumbai. GBP to INR is 77.52 in London. And GBP to USD is 1.6231 in New York. The arbitrager has USD 1 crore. Assuming that there are no transaction costs, explain whether there is any arbitrage gain possible from the quoted stock exchange rates. So is there any exchange possible over here? Yes. Is there any arbitrage gain possible over here? That is what we have to calculate over here. Now, first and foremost, before we start, do you find something which is an anomaly over here? Do you find any anomaly over here? It is written USD upon INR, but actually this is quoted in rupee. This is quoted in rupee. This is quoted in dollars, which means, which is the base currency over here? Base currency is dollar in the first one, GBP in the second one, and third one also it is GBP. Are you with me?
Yes, sir.
Now you might say, sir, how do you know this is the case? Right? So you know for a fact GBP INR rate is this much. We have spoken about it in 48.30 in Mumbai, and then in dollar it is 1.6231. So that being the case, now we need to identify first and foremost, is there any arbitrage gain possible? So first and foremost, I need at least 2 rates to compare, right? What is the rate available? So arbitrager has which currency available to him? Which is the currency available with the arbitrager?
USD.
USD. So that means the third rate which is there, sorry, so third rate which is there, because he is having, his currency is USD 1 crore, which means he is basically there in New York, right? Your arbitrager is basically situated in New York because this is his home currency. So now here I am not going to touch this particular element at all because this becomes my one reference rate. This is my one reference rate. Are you with me? So what is my first reference rate, which I am going to keep it frozen, is it is dollar upon pound 1.6231. And why have I chosen this? Because this is the home currency of my arbitrager. Are you with me? Okay. Now I am going to find the second rate, because based on the second rate, whatever rate I get, because again I want to find which rate? I want to find which rate? I want to find dollar upon pound again. Remember? I want to find again dollar upon pound rate. This is what I want to find. Because then whatever rate I get as per the cross currency calculations, I will compare the two. if the two values are not same, there is an arbitrage opportunity. So how does that work? Let's see. So I want dollar upon pound rate. For that, how will I compute? I need dollar to be there in the numerator in one of the rates, right? And in another rate, dollar has to be in the, in another one, pound has to be in the denominator. So which is the other currency, third currency which is available over here? Which is the third currency which is available over here? Rupee.
INR.
Right? So now I am going to check over here. Do I have rupee to GBP price available to me? Yes, rupee to GBP price
Yes,
is
sir.
77.52, 77.52 in London. That is available to me. Do I have dollar upon rupee rate available? I don't have dollar upon rupee. What I have is rupee upon dollar. So how do I convert this direct quote into indirect quote? How do I convert direct into indirect? I will say it will be 1 upon 48.30. Right? So when I do this calculation, now I will get what is the cross currency rate for dollar to pound. So what is the cross currency rate coming to? 77.52 divided by 48.30. How much is that coming to?
604.
605.
1.605. Now, since both the rates are not same, is there an arbitrage opportunity possible? Is arbitrage opportunity possible?
Yes.
Yes.
Yes. Now, remember in both the cases, your quoted currency is pound, remember? Quoted currency is in pound. So, pound is quoted in New York at 1.6231 and it is quoted at 1.605 when you go through INR, that is from Mumbai, and then go to London and buy the foreign currency. So, you will get it cheaper. So, will you buy it this way or will you sell it over here? What is strategy? What will be your strategy? Yes. Because you want to essentially the same amount, you have 1 million, 1 crore, right? USD available to you. You have 1 crore USD available to you. Hello.
Yes, sir.
So what will I do over here? I will convert first and foremost from New York, right? I'm going to first of all go to Mumbai, then I will go to London. How do I do that? So first I will convert. Step 1 will be convert
Dollar into
dollars
rupees.
into
Rupee.
rupees. So how much will I get? 1 crore into, what is the rate for buying rupee? Yes, 1 crore dollar will be converted into 48.30 rupees, right? So it will become 48.30 crores. Now I have 48.30 crore rupees. Now what I'm going to do, step 2, I'm going to buy pounds, right? So convert rupee into pound. How do I do that?
Rupee 48.30 divided by 77.52.
Yes. So I will say 48.30 crores divided by 77.52. So I will get how much GBP? I'm waiting for your help if somebody is helping.
62,000. 62,306.5.
62,000? You mean to say 62 lakhs? Hello? So I have
62 lakh 30,615.
So I get this much pounds. Now, what I can do is I can take this pound and convert this pound into dollars. Where? I'll convert this pound into dollars. Where? This I will do it in
Then
New York now. So I'll bring that pounds from London to New York and I will convert this pound into dollar. So I have now 62,30,650.155 into 1.6231. So I'll get how much?
1,01,12,968. 68.
968. Okay.
0.26.
0.26.
26.
Okay. So 1 crore 1 lakh. Now remember what was my original investment?
1 CR.
Original investment was 1 CR. So basically, in other words, what is my arbitrage gain?
1,12,968.
Yes, 1,12,968.26. Right?
Yes.
Got it, everyone?
yes, sir.
Okay.
Yes, sir.
Now, shall we take a break of 10 minutes?
Yes, sir.
Ashok ji? Okay, thank you. I'm just mentioning one example over here. At spot 1 HKD. HKD stands for Hong Kong dollar. Is 5.70. And covered yourself in London market on same day. Exchange rates were $1, which is US $1 equal to HKD, that is Hong Kong dollar, 7.5880. 7.5 9 0. Local interbank market rates of USD or US $1 is 42.70 rupees, 42.5. We are supposed to calculate cover rate and compute profit or loss in transit. Okay. Ignore brokerage, transaction cost. Add that also. Ignore transaction cost. So we have already discussed what is a two-way code, what is cross rate, right? Now we are going one step further ahead, building on to that. What is cover rate? So when does a cover rate come into the picture? If I am a banker and or an authorized dealer, and I receive a particular client who either wants to buy or sell a particular foreign currency. So as a result of that, I have already got an exposure, right? Now, the moment I have got an exposure, I need to essentially cover that exposure by buying a opposite cover so that I have a, you can say buy to sell or sell to buy available to me, which means because I am not the one who is holding on to the currency, right? So say, for example, if a client comes and I have, in this particular case, I have sold 1 crore Hong Kong dollars, right, at 5.70 rupees. Remember? Now I need to cover myself because I will have to essentially, since I have sold 1 crore HKD, I will have to buy from somewhere, right? So I have to go out and buy 1 crore Hong Kong dollars to cover the position. Now, obviously, if I have sold it at 5.70, I need to buy it at a lesser price so that I will make some margin. Do you agree on that? I am not doing this business for charity. I am an intermediary, yes, but at the end of the day, the spread in between will be my margin, right? Or profit or loss or whatever you call it. So I definitely want to make some money out of it. So at what rate will I be able to cover? Now, remember, exchange rates which are given to you US dollar to HKD. And you are given further in the interbank rates, you are given US dollar to INR. So INR to HKD direct rate is not available. So you will have to essentially use over here Again, cross currency rates. Are you all with me? Are you getting hang of the situation? What you need to do? I have sold HKD. Hello, am I audible?
Yes, sir.
Okay. So I have sold HKD. So now I need to buy HKD, right? I need to buy Hong Kong dollars. For buying Hong Kong dollars, since rupee is not directly trading with Hong Kong dollars, it is not directly quoted. It is quoted through US dollar. So what is the thing happening over here? If you want to buy a Hong Kong dollar, remember this is a bid price and ask price, right? What is bid price? Bid price is, this is bid price. This is ask price, right? This is the price at which bank will buy HKD. I want to, essentially, you want to sell to the bank or you want to buy from the bank? I want to buy from the bank. So the rate which becomes important for me is ask rate over here. But in order to buy HKD, I need to first of all have dollar in place. And I don't have dollar because my local currency, my domestic currency is INR. So first and foremost, what I would need to do is, I would need to buy a dollar, right? So what will I need to do? I want a rate which is rupee to HKD. Am I right? This is the rate which I want to find. And I want which rate? Ask rate or bid rate? I want ask rate. Why? Because I want to buy. I am the customer here in this case. So forget the situation that I have already sold HKD. But now when I want to buy HKD, remember I am the customer over here now. Okay. So I am not the bank over here now. I am the customer. So as a customer, what is the ask rate for me? Ask rate is going to be 42.85, right? All right. So when I want rupee to HKD ask rate, so I will have to multiply over here, right? How will I go about it? How will I go about it? So I have over here rupee to USD, that rate, again ask, remember, into, now I want in the denominator which currency? HKD. So I want HKD over here. And this also has to be ask rate. HKD is in the denominator. In the numerator, which currency should be there? See over
USD.
here, US dollar. So I have to have US dollar over here, right? Now, do I have the rates available with me for both this? Rupee upon dollar, ask rate is available to me. Rupee upon
Yes.
dollar is available to me. 42.85. 42.85, yes, available to me. Into, do I have the rate of US dollar to HKD? Check it out, please. Here, the rates which are given are, which is the base currency over here in this quote? Which is the base currency in this quote? US dollar is the base currency, quoted currency, right?
Yes,
So
sir.
these quotes are basically given to you as what? They are not given to you as dollar upon HKD. They are given to you Hong Kong dollar upon US dollar. Are you with me? These quotes basically are given to you what? 7.5880, 7.5920. It is HKD upon US dollar. And what you want over here is US dollar upon HKD. You want the reverse of it.
So
So
1
when you
divided
are
by
doing the reverse,
7.588.
yes, it will be 1 upon
7.588.
Very good. The bid will have to be reversed over here, right? So when you convert direct quote into indirect quote, remember, bid will become inverse of the ask, right? So I will have to do over here, my ask price will be inverse of bid, which means it will be 1 upon 7.5880. This will give me the rupee upon HKD new ask rate. What is the rate going to be? Can you give me the number over here?
5.6.
5 point
5.64.
5.6
6470. 4.
5.6
5.44.
5.64
70.
71. Okay. 5.6471. Now, check the rates first of all. This is called cover rate. This is called cover rate. Okay. What is the meaning of cover rate? When you have done a particular transaction, you need to take an opposite position, right? So that you are able to cover your earlier transaction. Because you have sold HKD 1 crore. I do not have 1 crore HKD. I have sold it to him, but I do not have 1 crore HKD. So how will I deliver that 1 crore HKD? So for that, I will go to the market and buy it. So what is the rate at which I am going to cover this transaction, right? So that is called as cover rate. So 5.6471, and remember I have sold it at what rate? 5.70. So will I be making some profit in between? Will I be making some profit in between?
Yes.
I'll be making some profit, right? So how much profit I will be making? Let's see. So how much is going to be my inflow? First and foremost, what will be my inflow? Inflow from sale of HKD 1 crore. How much you will get? 1 crore into 5.70. So you will get 5.70 crore. Am I right? How much will be your outflow? Outflow for purchase of HKD. That will be, you want to purchase how much? 1 crore. At which rate? At cross rate, which is 5.6471. So that comes to how much? 5 crore 64 lakh 71,000. Right? So the difference, you have received an inflow, right? And then
5,29,000.
5 lakh
29,000.
This is the profit. Am I right? 5,29,000 is your profit, or you can say gain on this particular transaction. Okay. So we have covered over here. How many concepts did we cover? We covered first of all what is forex rates. We covered what is direct, indirect quote. We have also covered how to
Cross
calculate.
rate.
Yes, cross rate, yes. But first of all, we started with direct quote, indirect quote. Then we also discussed what is American term, European
Yes.
term. What is American term? Remember, in American term, dollar will be in the numerator, right? European term, dollar will be in the denominator. That is what we also follow in India. So we express it also as a European term of forex rates, right? Then we discussed two-way quote, bid and ask. Bid is the rate at which bank will buy, or as far as we are concerned, we will sell, right? The customer will sell. And ask is the rate at which we can buy from the bank. Then we discuss what is cross rates, cross currency rates. We have also now covered what is cover rate. We have covered today spot rate, arbitrage rates. We have also covered what is arbitrage opportunities available in the triangular cross currency transaction. We have discussed that. Yes, we have also solved one question on that. Next is, what is the net exposure of each foreign currency? Now, what do you mean by net exposure of each foreign currency? So say, for example, if somebody is a dealer who is doing transactions in multiple countries, so he has multiple currency exposures, right? Now, as a result of that, you may have some obligations which are in, say, for example, dollar terms. You may have certain receivables in terms of dollars. So here, by way of net exchange, what we are trying to essentially say is, if I have a receivable if I have receivables, okay, I am going to take an example of, let's say, for example, dollars. Okay, if I have receivables of, say, for example, $10,000, and I have payables, okay, of, let's say, for example, $9,000. So $9,000 is my liability or my exposure. 10,000 is receivable. So again, my exposure is there. However, if assuming that the payment dates are the same date, meaning the maturity date of this particular obligations, receivable and payable, is coinciding with each other. Say, for example, they both are falling due on 31st of May. Say, for example, both are falling due on 31st of May 2025. In that case, the net exposure which is there is only for $1,000. So what is my net exposure? Only $1,000. Are you all with me? Right? So if I have to do any cover, if I have to take any cover for this particular exposure, then that would essentially be only and only for $1,000. Right? Now that brings me to the concept of something known as hedging. Right? We will obviously delve deep into it a bit later. But what is the meaning of hedging? What do you mean by hedging? Any ideas? What I am trying to do is, you can see this $1,000 is my net exposure. What if today the rate is $1 is rupees 85? And say, for example, because of this tariffs, etc., whatever is happening in the global trade today, let's say I'm expecting $1 will become rupees 70. I have a huge exposure over here, right? I will have a loss of, for $1,000, I will have a loss of how much? I am anticipating now a loss of 15,000 rupees. Are you with me?
Yes,
This is
sir.
my exposure. Now I want to hedge this exposure, meaning I want to avoid this exposure. So today I want to take some position which will help me in managing my risk, because my current risk is 15,000, which I believe is too much. So I want to cover, or I want to protect my receivables, right? I don't want to have this risk of 15,000. So how can I avoid that particular risk? So hedging is the, you can say, one of the important ways in which you do risk management with regards to your currency exposure. There are various techniques which are available, which we will discuss slightly bit later, right? Prior to that, I would like to touch upon a couple of other concepts which we had discussed earlier as well. We have solved also sums on that in my regular sessions earlier, but I want to at least go through a couple of approaches which we have discussed today also. One of those approach was interest rate parity. Remember? So when we talk about exchange rate theories, there are two very, very important theories which are there. One being IRP, interest rate parity, and purchasing power parity. So here, your exchange rates in case of IRP, in case of interest rate parity, your exchange rates are assumed to be the function of interest rates in the two countries. So say, for example, today the exchange rate which is going on is rupees 85 per USD, right? And I am expecting that in the next year, I am going to on INR currencies, I get returns of, say, for example, 10%. While on dollar, we are expecting returns of only 4%. Right? So what will be the new forex rate a year from now? We just now calculated fair forward rate, remember? Just a while back, we calculated a fair forward rate when we were comparing with actual forward rate to identify the arbitrage opportunity. So you can find over here the same approach is there, because in that also we had taken the example of interest rates, right? And we have taken over here. So that principle which we used for calculating fair forward rate was interest rate parity. Are you all with me? So what will be the answer over here? What will be my fair forward rate, or as per the interest rate parity, what will be my expected forex rate? 85 into 1.1 divided by 1.04. No answers? Okay. So how much is that going to be? 85 in 1.1.
89.90.
89.90.
89.9038. Right? Now, same way, we have another principle or approach, which is purchasing power parity. How does purchasing power parity work? Instead of interest rate, we are going to consider the purchasing power, and purchasing power in economics is always measured by way of inflation, right? So here I will take spot rate and multiply that with 1 plus inflation rate in my domestic currency upon 1 plus inflation. Now we are talking about not interest, remember, we are talking about inflation, okay, in foreign currency. So in the foreign country, we are not talking about just in currency terms, but in the country terms, right? So that becomes my new exchange rate, which will be there. So for example, if my spot rate is today rupees 60 for each dollar, inflation in India, say for example, is, let's say, 6%, while inflation in US is, let's say for example, 2%. Then in that case, it will be 60 into 1.06 divided by 1.02. So that will come to
62.35.
62.35. 62.35. Okay. Now this becomes my forward rate, or you can say expected spot rate. You can say forward rate, or you can say expected spot rate based on purchasing power parity principle. Right? So there are various methodologies otherwise in theoretical term. Now generally on this particular topic, foreign exchange and risk management, because there are 8 different types of questions which can be there, 7 to 8 different types of questions which can be there. Generally this topic has been very, very favorite of most of the examiners. And you will find that these questions generally, this particular topic generally finds representation in your final paper anywhere from 6 marks to 14 marks. If a particular paper does not have a question on forex and risk management, then it is a bit of a, you can say, a surprise or an outlier which is being, a googly which is being played out on the students. Otherwise, more often than not, you will find, because there are so many different varieties which are available to test the student, right? So that is the reason, also one of the reasons why I would request all of you, if possible, please go to the regular sessions which we have discussed in detail, because there we have solved almost 33, 34 questions. It will be very, very useful to you for your practice purposes. Okay. All right. Now, for exchange rate determination, as we discussed about interest rate parity and purchasing power parity, there are 3 to 4 other reasons also which may have an impact on forex rates. right? So one being deficit or surplus on capital or current account, which is your balance of payments position, because of which you may have certain restrictions coming in, right? Like for example, currently, if you are traveling, then you can carry, say for example, let's say $10,000, which you can carry along with you for any of your foreign travel, etc. If government changes this particular norm to, let's say, $20,000 or $30,000, etc., that particular change may have an impact on how people essentially carry their money, right? Second is there's also trade barriers which are there. Now, trade barriers may be both which are tangible trade barriers and intangible trade barriers, right? In terms of your import duties, etc. This time around, I believe all of us, even if we had not studied probably indirect taxes, then also we have learned, I think everybody in the world has learned about tariffs, right? So that is one good thing which has happened because of whatever is happening in US. Everybody knows now what is the meaning of tariff, what is the impact of tariffs. That can also have a role to play. Intervention by central government in India. We have full convertibility, rupee convertibility into foreign currency on current account, right? Capital account is full convertibility is not allowed by the government as yet, right? So that also will have an impact. Obviously, a lot of the international governments are trying to push the Indian government right now that you make capital account convertibility into India and whatnot. But that will essentially mean that all your capital assets are free to acquire, and considering that we have limited supply of resources available, that can essentially play into the hands of manipulators, right? That is the reason government is not opening up that particular aspect. But if opened up, that will also have an impact. Government controls definitely has a role to play. And then also there are certain expectations. Like for example, earlier, not many people in India were traveling abroad, right? If, say for example, if I talk even my childhood days, at that particular point, if people were traveling basically for vacations, etc., also, it would be somewhere in India, right? You would be traveling to Kashmir or South or whatever. That was predominantly the norm. While now, in today's time, you find so many people are traveling abroad, right? And that has become the fad. That has become the way of life. People have huge aspirations about it, that I want to travel the world, I want to do this, that, etc. Of course, that is because of the growth in the economy, but also when you start traveling, you will spend in foreign currency, right? And as a result of that, will also have an impact on your balance of payments position. Now, we just now mentioned about hedging. So I'll discuss about in brief today about the different hedging techniques. The questions also on them. If today we have time, we will take it up today. Otherwise, in the session which is there tomorrow, we'll take up more questions. Mr. Prashant? Thank you. Okay. So now, when we are talking about hedging, currency risk, right? So in that case, I have two options available with me, or rather with every businessman or a client as such, right? They have basically two options. First is internal techniques and external techniques, right? So what are the various internal techniques? First is, if I want to avoid currency risk, the best thing is I do invoicing in my home currency, in domestic currency. So I do the invoicing in INR I don't care what is the forex rate. I want my amount to be paid in INR, 5 lakh rupees. I want to have that particular 5 lakh rupees being received. So you do whatever you like, but you pay me in INR. Now, as a result of that, I have done is I have put the onus of that particular entire risk onto the other party, right? Then second is leading and lagging. What do you mean by leading and lagging? Any ideas? Leading and lagging? Yes, anyone? So leading and lagging essentially means whether you are going to pay the money. If I can pay the money today, meaning before maturity, right? So if pre-maturity I make the payments, I am eligible to get some discounts, etc., from my customer. Also, if there is a possibility of getting some better favorable forex rates, that could also be an incentive for me to make prepayments, or I might essentially do the payments after a particular lag, depending on obviously which option will yield better inflows for me at the end of the day. Third option is netting. Third option is netting. What do you mean by netting? Netting, where I am essentially doing the, we just mentioned earlier about how I am essentially going to take into account the net exposure of my proceeds, right? So I can essentially do netting if the due dates are matching, or try to bridge the gap in between and try to take a cover only for the net exposure. Similar concept, but slightly different, where I can do matching. Matching is essentially, as you realize over here, we are trying to match a particular asset and liability, right? So that when they match together, then in that case, I will receive, for example, $10,000. I have to pay $10,000. By matching the due dates, my job becomes a lot more easier. So that is a good option. Say, for example, I'm going to receive my money. Let's say I have to receive my money on, say, for example, 30th of June. Okay. And I have to pay on, let's say, for example, on 15th of June. Now I have two options available over here. One, I can essentially reach out to my client and say, you pay me 15 days earlier, I will give you some rebate, etc. Right? And thereafter pay this particular amount so that I don't have to worry about the forex exposure as such, because then I will have to do very less transaction in forex. Alternatively, there is also a possibility that maybe I am going to get some benefit, and as a result of that, I want to receive it at 30th June after 15 days. In that case, I might probably borrow the money over here, right? And probably I might stretch it, my obligation, to another 15 days, because maybe the other client is willing to say that, okay, you can pay me after 15 days, but then I will charge you, say, for example, X amount of extra charges or interest for delay payment. So you incorporate that and try to see that, okay, on 30th June, if I'm going to receive better money, then I would go and do it that way, right? When does that essentially happen? Maybe my forward contract is already there in place. So on 30th June, maybe I have a forward contract of, say, for example, of 100K, $100,000, right? And here I have to make payment of, let's say, for example, $50,000. Now you can see over here, just for the fake of 50,000, if I essentially break this entire foreign contract, or I take the entire 100K earlier, I will make more loss. So in that case, the totality wise, I can do some matching. Next is price variation. You can vary your prices. This happens generally in perfect competition. where you charge different prices to different markets, right? So if you are in a position and you have that particular demand in the market, you can vary your prices. I don't know how many of you are aware, but of late, a lot of the times, Indian government and a lot of the different stakeholders have been voicing their opinion about that since there is a huge tariff being, tariff war going on between US and China, a lot of those supplies will be diverted and they will essentially do the dumping of their products into India at a cheaper price, right? Now that essentially again becomes a price variation because the commodities for which probably US might have paid probably maybe $5 or $10. But at this particular juncture, if China is not in a position to sell those products in the US, what they would rather focus on, as you have learned in economics also, right? As long as they're able to recover their variable cost, they would essentially be able to remain in business. That we have learned in standard costing as well, right? So what they will try to do is they will try to essentially, as long as I am able to recover my variable cost, they'll dump it into India. And for that, they have two things to consider. One is the price which Indian government or rather Indian consumer is going to pay. Plus, on top of that, the subsidies which they will get, the export incentives which they will get from their government. So as long as that two of them together is giving them returns in excess of their variable cost, they will obviously feel more energized and happy to dump it into India. Because at least mera maal bik gaya, at least my commodity has got completely sold out, right? I don't lose out on, I don't have to fire my people, I can retain my people, and in the long term, obviously, government will be able to find some better solution and whatnot. It buys you that much time for survival. So if you can do price variation, that also becomes a very good opportunity. And next is asset and liability management, right? Which is the example which I had given earlier also. If you have an asset and a liability, you can essentially try to maneuver and try to find that, okay, I'm able to do some kind of a management as a result of which my risk in a particular currency will be reduced substantially, right? These are all internal techniques to the client. What are the other external techniques which are available to him? So he can even opt for outside his organization, he can opt for money market hedge. What do you mean by money market hedge? Yes, anyone? Anyone? Money market hedge? No idea? You can even buy some forward covers, future options, etc. Right? So those money market hedge, you can essentially buy the products in the money market as well to cover your positions. These are basically the ones which are there as options available. We will explore them in detail with questions with each of the individual topics. Now, in the questions which I have shared with you, can we take up question number 2? Let me take question number 2. So we are going to essentially try one of the hedging techniques over here with the help of question. All right. So this is the question. Question number 2, which I have shared with you guys. It's a question again on decision making, where we will have to take the decision of, sorry. All right. So Z Limited importing goods worth USD 2 million requires 90 days to make the payment. The overseas supplier has offered a 60 days interest-free credit period and for additional credit for 30 days, an interest of 8% per annum. The bankers of Z Limited offer a 30 days loan at 10% per annum and their code for foreign exchange is as follows. Spot 1 USD is 56.5. 60 days forward for 1 USD is 57.1 and 90 days forward for 1 USD is 57.5. You are required to evaluate the following options. Pay the supplier in 60 days or avail the supplier offer of 90 days credit. So here we have to identify where we have to pay any which ways, but which option will essentially lead to a lesser outflow, right? So as long as my total outflow over here is lesser, that is the option which I would want to opt for. So how do I go about it? How do I go about it? If I have to pay the money, right? I have to pay the money after 60 days. So if I pay the money after 60 days, what is the rate at which I will have to buy the dollars? I will have to buy the dollars at 57.1. Are you all with me? So let us take the option. So let us take the first option. Pay the supplier in 60 days. Yes. So if I have to pay it, then what is the forward rate applicable for me? Yes, forward rate applicable will be what? After 60 days, it will be 57.10. Am I right? How much is the payment due? Payment due is $2
million.
2 million. So that means outflow in rupees will be how much? Outflow in rupees will be how much? 2 million into 57.10. So that will come to how much?
114.2.
114.2 million. Am I right? This will be in rupee. Plus I will have to pay interest, right? Why do I have to pay interest? Why do I have to pay interest?
Avail the 30-day loan.
Yes, I will have to avail a 30-day loan, right? So I'll have to pay interest on loan for 30 days. That will come to how much? That will come based on loan at 10% per annum, right? So that will be 10%, 10%, right, into 10 upon 100 into 30 upon. Can I take 1 upon 12? Or should I take 330 upon 360?
360.
Okay. And what is the amount? 114.20 million. So how much is that turning out to?
9,51,666.
9 lakhs
51,666.
951,666.
Yes, sir.
So I am writing 0.951 because we have written everything in million. This is 114.20 million plus 0.951. Right? So my total outflow now will become how much? Let me convert everything into. Now jayega. How much will that be? 115.
115.15167.
15167.
167.
Okay. So 115.15167. This is in million, rupees in million. Okay. Is million. Now this was pay the supplier in 60 days. Now what is the second option available? Second option available is pay the supplier by availing his offer of 90 days credit. So second option is pay the supplier in 90 days. Pay the supplier in 90 days. So first of all, how much is the amount payable again? Now remember, your supplier is providing, so you have to pay essentially in dollar terms, right? He is going to charge you interest in dollar terms. You have $2 million to be paid. Now you have to add interest on that. Interest at 8%, am I right? So it will be 2 million into 8 upon 100 into 30 upon 360. So that will be how much? $2 million. Now here it will be 13,000. 13,000, no? This will be 12. Right. How much is that coming to? 40,000 upon 3. So 13,333.
Yes, sir.
So now I have to pay 2 million, right? 13,333.33. 20,13,333 dollars. Now, what will be the applicable forward rate for this after 90 days? Applicable forward rate, which will be how much? 57.5. 57.5. So, outflow in rupee terms will be how much? 2013 into 57.50. How much will be the outflow? It is 115.
766,648.
766.
648.
648. So earlier we had 115, 15167 by 1667. 66. Yeah. So now, which one is better? Which one has a lesser outflow?
In case to better after 2 months.
It's better to pay the supplier in 60 days time, right?
Yes.
So I'll pay the supplier in 60 days because that will save me how much? You can, generally in the examination, it's always better to calculate the savings, right? Because in most of the question they will ask what is the incremental savings or profit or loss, etc. So what is the difference? 766, 648 minus 151,667. So how much does that come to? Savings on opting option 1, right? So you can calculate over here whatever is the amount you mentioned.
6,14,981.
6 lakh
14,981.
14,981.
81. 1.
614,981 says in rupees terms. Okay. Okay. Now there are some other questions also on hedging, but they will take slightly longer time. So I will discuss one concept of vostro, nostro, and loro. Vostro, nostro, and loro. What is the concept of vostro, nostro, and loro? Any ideas? Yes. Vostro, nostro, and loro. Yes, tell me. I think this is something which is a very, very easy concept. If it comes in the examination, then you really are very, very lucky. Because the concept is very, very easy, but nonetheless very, very important as well. So, what is the importance or meaning of this particular concept? Yes, anyone? All right. What do you mean by vostro, nostro, and loro? So, basically, we are talking about a situation where, say for example, there are two banks over here. Say for example, I have a Citibank, New York. Okay. And then I have a SBI Bank over here. SBI Bank, say for example, India, right? This is New York and this is India. Now, Citibank, New York has some clients in India, so they want to do some transactions wherein they can essentially help their clients so that they can make the payments, etc., and whatnot. Similarly, SBI does not have any presence in New York, for example, and they also want to do some transactions on behalf of their clients, etc., so that their clients are not inconvenienced. So what happens is Citibank New York is opening an account with SBI India, right? They are opening a bank account over here. Whose bank account? Citi is opening their bank account with SBI over here. Similarly, SBI is also opening an account over here. Let's say SBI is opening an account over here in Citibank, right? The idea being now, say for example, I am the client of SBI Bank and I say that I want to make payment of $10,000. I have to make a payment of $10,000 to a party in New York, somebody in New York. Now I give this instruction to SBI India. You debit the amount, whatever is the amount for this in INR terms, you debit it into my account, but you pay to my client $10,000. Now SBI India does not have any branch, but they have this particular account with Citibank, right? So they will instruct now Citibank that please pay 10,000 to so and so person, and you can debit that into my account. Are you with me? I repeat once again.
Yes, sir.
SBI India opens its account with Citibank. Citibank has opened its account with SBI in India. They both do not have their own branches over there, right? So now, in order to help their client, I am the client of SBI Bank, and I am telling them that, see, I have a bank account with you in India. You debit the INR value in my account, but transfer $10,000 to my client who is in New York. Now, SBI can offer this service only and only if they have a branch over there, right? Now, they have not opened a branch over there, but they have got an account over there. So, just like as if they are the ones who actually want to make a payment of $10,000 to the client. So, just like they will issue a check or a transfer amount from their bank account. Which bank account? Their bank account over here in New York. So, they will instruct Citibank, you please pay 10,000 to so and so party from my account. I have a balance with your account. Right? Are you with me? So, the concept of vostro nostro is, it is basically your account in my bank, my account in your books. Just like we used to have passbook, remember? We prepare passbook, cash book and passbook. We used to do bank reconciliation in basics of accounting. Remember, in the foundation, you might have learned that. So, same way over here, I have vostro and nostro account, which is basically my account in your bank, right? And vice versa. Now comes loro. What happens to loro? This is basically neither my account nor your account. Okay. So here what happens is, when I'm routing the payment through third bank, so I am telling SBI Bank, please debit whatever is the amount in INR terms, equivalent of $10,000, you debit it into my account. But you please pay to my client who is in Frankfurt. Frankfurt, right? Germany. Now I am asking SBI Bank to pay an amount equivalent to $10,000 to my client in Germany. Now, in Germany, SBI does not have a bank account. However, SBI knows that Citibank has an account over here with one of the German banks. City New York has an account over here, right, in the German bank also. So again, now here, what SBI is going to tell Citi is, you debit my account with you, you have my account with you, you debit my account with this $10,000, and you please pay on behalf of my client to so and so client in Germany, Frankfurt, because you have a branch over there, you have an account over there. So you are using somebody else's account now. Now you are not using directly your account. Are you getting the point? SBI does not have an account over there, but they know some another bank which has an account over there. So they are essentially asking that bank that you pay over there, and we will adjust into our account with you. Citibank is the bank where SBI already has an account. So they are informing Citibank, you please pay on my behalf $10,000 to so and so, because you have a presence over there. So you pay it and you debit it into my account. This is called loro account, meaning third party account. Somebody else's, other person's account. Are you all with me? On this particular topic, there's a very simple question which is there, right? So you may have only two things which are there is the position of whether you may have overbought account, overbought account meaning where your currency purchased by you is more than your currency which you have sold or transferred, right? So then in that case, that means it has a positive balance in your account. So unlike your normal bank account where we say it has a debit balance or credit balance, here you say it is overbought or oversold. Now obviously normally oversold is not a position which is allowed, because then in that case you are essentially into negative, right? Unless and until you have some arrangement. So generally Vostro Nostro will not have negative balance, you will always have a overbought position, right? So overbought position meaning that you have a certain amount which is already there. Second aspect or the adjustment which will be there in Vostro Nostro accounts is you want to ensure that at the end of the period as well, you want to maintain some running account balance, like you are on an impressed system, which we maintain generally, cash bank system, right? On an impressed basis, that you want to maintain at least $5,000 or $10,000 in your account. So keeping that much amount of money, the balance will essentially have to be settled out. Either you are withdrawing or you are essentially paying out, right? So Vostro Nostro and Loro account is a very, very simple and easy topic. We have solved this particular, in fact, there are only 2 questions, and I have solved both the questions from your self-test questions also, and also your one of the question which is other also there. We have solved both the questions in assignment number 3, which was done in our other earlier regular lectures. So you may please refer to that, right, to get hang of Vostro Nostro and Loro account. Now that brings us to the conclusion of the session today. Again, before I conclude, what are the things we covered today? We have covered today what kind of transactions, generally types of transactions which involve foreign currency. So it is generally international transactions. Then steps where we calculated return on investment from investment in foreign currency. Remember, we had done an example of Tesla, where we invest in Tesla, we buy the share for 50, it becomes 60 plus dividend, etc. So we computed the return on investment. Then we also covered quotes of currency, direct quote, indirect quote, American term, European term, two-way quote, bid rate, ask rate, how to convert from their two-way quote into direct into indirect. So your bid rate in direct quote, how will you convert that into an indirect quote? It will basically be your ask rate. Bid will become ask, but it will be in the denominator, right? So your equation will change. It will be inverse of your bid rate. So your ask rate now in the indirect quote will be inverse of bid rate, and your bid rate in your indirect quote will be inverse of your ask rate, right? So we did that. Thereafter, we have also done today cross rate. We have also done cover rate, spot rate, and forward rate also we covered, right? We also covered what is the spread in between the two rates, spot rate and forward rate. One point which I wanted to mention, I'm glad that I recall immediately. So say for example, where my spot rate is, say for example, in some of the cases you will find that they generally mention in terms of forward points, right? They call it as swap points or forward points. So say for example, your spot rate is mentioned as $1 is equal to, let's say, rupees 85, rupees 87, right? Now here you will see there is, say for example, 85.10 to 87.20, okay? And then your forward points of, let's say for example, 30 days, it says it is 20/25. And 60 days, it says 25/30. So what is the meaning of this particular forward points? So what it basically means is directly your forward quote, a 30-day forward quote is not being provided. You will need to compute that forward quote. So how that works is you have to have 85.10 is your bid rate. So this basically is your bid points, and these are your ask points, right? So how you will say is, first and foremost you have to see, is this in premium or is it in discount? So how will you come to know that it is premium or discount? If the numerator over here is lesser than your denominator, that means it is in premium, positive. if your numerator, because this is 25 upon 30, you can see. So if the numerator is lesser than the denominator, it means it is in depreciation, meaning it is trading in discount. Okay. So when I have to calculate my forward rate now, say I want to calculate 30-day forward rate. So how will I calculate? I will say it will be 85.10 plus 20 points, meaning it will become 85.30. Similarly, my ask rate will become 87.20 plus 0.25. It is 25 points, remember? So it will become 87.45. Now, since the next one is a discount, remember? So here what will happen is my forward rate is going to be 85.10. I'll go back to my original rate, not the 30-day rate. 85.10 minus 25. So that will work to 84.85, right? And my ask rate will be 87.20 minus 30. So that will come to 86.90.
86.90.
Okay. So we have covered these points. Then we also discussed about interest rate parity, purchasing power parity. And today we have mentioned about what are the different internal techniques and external techniques for hedging. We will be solving sums, and we'll also be discussing hedging techniques tomorrow in our next reversionary lecture. I still recommend and request, if possible, please go and refer all the regular lectures which we had done earlier in the month of December. It's available online, right? So please take benefit of that. If you have any doubts, any queries, please let me know right now. Is my language understandable for all? Was it comfortable?
Yes, sir.
No doubts, no queries? All right. So we will conclude over here for the day. Ashok ji? Yes, sir. Thank you. Thank you.
Thank you, sir.
Everyone.
Thank
For
you all.
participating. Thank you very much.